Aloha students, and welcome to the lecture on Chapter 12. In Chapter 12, we're looking at analyzing and interpreting financial statements. I believe you have gone through this before in your MBA 510 classes. So this topic kind of crosses over between financial accounting and managerial accounting. But the main focus of this chapter is looking at financial statements and analyzing how well a company is doing based on the financial statements. So as you can see, the objectives of financial statement analysis is to look at past performance through financial statements and current financial position of a company. This information, the past and current information, is used to make future predictions about a company to help make, as you can see, difficult managerial decisions. So this is the intersection between financial accounting and managerial accounting, using financial accounting information, financial statements, to make managerial decisions. Okay. All of the things that we're going to look at in financial statement analysis really involves making comparisons and looking at relationships between numbers. A couple of concepts. Horizontal analysis. Basically, that means you're looking at comparable items from one period to another. Okay, so you're looking at, for example, inventory changes from last year to this year, or how the trend of inventory has increased or decreased over the past, let's say, 5 years. Okay, so horizontal, you're looking across time, okay, at different years or different periods. On the other hand, vertical analysis is looking at, for a particular year, the financial statement items as a percentage of something similar. So for example, an example for we individuals might be, let's say rent on a monthly basis was $1,500, and let's say our total income for the month was $3,000. So this month we're paying 50% of our income goes to our rent. Let's say next month the rent stays at $1,500, but our income falls to, let's say, $2,000 for the month. Then the percentage of our income that we pay for rent dramatically goes up. So that's the kind of analysis that you do for vertical analysis. You're looking to see for particular items what percentage of, and for income statement items, you usually look at a percentage of net income or revenues, one or the other. And for financials, for balance sheets, we look at items as a percentage of total assets. Okay, so again, horizontal analysis, you're looking across time, similar items over time. Vertical analysis for a particular year, you're looking at how big things are in comparison to total revenues or total assets. Okay. An important part of financial statement analysis is looking at trends. And to get a trend, you need at least 3 years worth of information. So trends basically shows the amount of increase or decrease over time. And that's helpful information because pretty obvious that, for example, net income, if net income is going up every year for the past 3 years, that's a good thing. The trend is positive. On the other hand, if income is falling every year for the past 3 years, the trend is downward. Oh, that's not a good thing. So looking at trends kind of gives us an indication of how things are going, and then we can use those trend analysis to look into the future. So if, for example, income has increased every year for the past 5 years, we can make the assumption that the trend will continue upward next year for the next few years. And that's the thing. So trend percentages gives us a picture of how things change over time. And then ratios. Ratios are simply relationships between items in the financial statement, and we'll see a bunch of those as we go through this thing. Don't worry so much about the government reports. This is more financial accounting focused, so won't talk about that much. Where do we get the information for doing these financial statement analysis? Well, obviously from the financial statements and the related notes to the financial statements, but there's other documents that are presented along with the financial statements. Letters to stockholders, for example, by management to discuss what's going on, independent accountants or auditor reports, and then management discussion and analysis, which is a section of the financial reports along with the financial statements and the the notes to the financial statement. There's usually a section where management discusses the financial statements and gives explanations about things in the financial statements. So you'll find that frequently either on company websites or on information that gets sent out in financial reports. Also, for publicly traded companies, so big companies where the public can buy and sell stock, it's fairly easy to find information about the financial statements because it is public information. So those companies have to submit financial statements to the Securities and Exchange Commission, who then make that information public. So find that in business publications, newspapers, magazines. You'll find them in all kinds of websites. So it's not hard to find financial statement information. Okay, so let's take a look at horizontal and vertical analysis. So again, we're looking at financial statements, either balance sheet or the income statement, and looking at or comparing things that are on there. So, yeah, they didn't do a very good job of presenting this, but they did a really junk job actually of presenting this, but they should have shown you the balance sheet so you can see where these numbers came from. But let's say that a balance sheet, the current assets increased by 14.3 million. So from last year, this year, the current assets went up by 14.3. The current liabilities, if it goes up $181 million. So you can see that the relationship between current assets and current liabilities, oh, the liabilities really went up a lot, much more than the assets went up. And that's not a good thing because liabilities means you owe money. So the amount of money that you owe really substantially increased compared to the assets that you have. Oh, so that's a bad thing. Total assets, another example would be total assets increased 311 million, while total liabilities decreased by 114 million. Oh, that's a good thing. Your assets went up, so things that you own went up. The amount of money that you owed to other people went down. Ooh, that's a good thing because you got a lot more assets than you had and you have fewer liabilities than you had. So overall, that's very good for financial health. Okay. So another piece of analysis that we can see is, say that the total increase in total assets, that $311 million, it was financed by operations. In other words, financed by operations means that's profit. Okay. So they didn't get money from borrowing. They didn't get money from selling off other assets. They got money by just doing what they're in business to do. That's what finance by operations means. So that's a good thing. Okay, their assets went up. Cash probably went up by 311 million because of their normal day-to-day operations, the profit from what they do. That's a good thing. Okay. So anyway, that's the type of thing that you look at when you're doing horizontal analysis. Again, looking at how certain things in a balance sheet, in this case, went up or went down, and how that compares to other things within the balance sheet. So gives you an overall picture of the financial health of a business. And that's all of the stuff we're going to look at in this chapter are all about, giving an indication of how well a business is doing. Okay, so if you look at the income statement, and let's say that there were increases in sales of 4.7%. Your gross profit went up by 7.3%. So your selling general administrative expenses went up by 6%. Don't worry about the tax part, but the increase in net income was 269%. Okay, so even sales only went up by a little bit, 4.7%. And gross profit is your sales minus the cost of goods sold. So whatever it costs to buy inventory that you sold. So that went up a little bit higher. So it looks like it cost less to buy the inventory that they sold. That's why the profit went up by a little bit. Okay. But notice, look, increase in net income, 269%. So that means the net income really went up a lot, even though the gross profit only went up by a little bit and sales only went up by a little bit. So there must be something else going on. And, this is kind of technical, but if you go further, you'll see that a huge amount was due to this thing called structured operations. Don't worry about it, but just be aware this is an unusual item. Okay, and that's why the net income increase was so big, because of this one-time unusual item. Okay, so anyway, that's the thinking process behind horizontal analysis. Is, hey, if sales only went up by 4%, how come the net income went up by so much? So these horizontal analyses are basically a starting point to look for things that look out of line or look kind of weird, to do some follow-up to see why it looks so weird. Okay? So again, for example, sales went up 4.7%. Gross profit, though, went up by more, 7.3%. So the assumption is, and it looks like it's because it cost them less to buy the stuff that they sold. So then you dig into it, or we accountants dig into it, to see if that's true. How come the gross profit went up way more than the sales went up? And we look for explanations. Okay, so that's what financial statement analysis is all about. Okay, trend percentages. Again, it's how much something went up or went down compared to a base year. So let's say that 2011 is a base year. So everything for that year gets a value of 100. Okay. Then everything after that is expressed as a percentage of that 100. Okay. So example here is, if sales are 200,000, we say then that base is 100. Okay. Next year it goes up to 220,000. So basically what you do is you divide the 220,000 by the base year of 200,000, and you'll get 1.10. Okay, you multiply that by, or move the decimal place over 2 places. 110 is the index. So 2011 is 200,000 divided by 200,000. So that's 1, or 100%. The following year, that index goes up to 110%. Okay, so again, that means that our sales went up by 10%. Okay, so that's what a trend does. It gives you relative sizes of increases or decreases from year to year. The first year is always the base year that we have in our that we're looking at. So whatever the dollar amount is, the index for that year is 100% because that's what the base year is. Yeah. And then everything after that, we take a percentage of that amount compared to the base year to get the index. Sometimes it's easier to think of these indexes as percentage. So this is, rather than 100, think of it as 100%. Instead of 110, think of that as 110%. Okay, so they should have put the percentages in here because it indicates here trend percentages, but be aware these index numbers are percentages. Okay. So again, this is just saying that we use trends to look at, okay, or to as a starting point for us to find out why things went up or why things went down. Okay, as you'll see throughout this chapter, horizontal vertical analysis, trend percentages, and ratios by themselves, they don't mean a whole lot. They're just indications of things we should be looking at. Okay, they don't tell you the whole story. It's just a starting point for then finding out about the story. Okay. Let's see. Okay, so now we're looking at ratio analysis. Ratio analysis, again, are indications. You're comparing numbers, the indications of how financially stable a company is. So when we look at ratio analysis, there's categories, liquidity ratios. These are ratios that, as you see here, indicate a company's short-term debt paying ability. Can a company pay back debt when it becomes due? Okay. One of the more common ones, and you've learned this in your MBA610 class, is the current ratio. Your current assets, that's assets that will either be converted to cash or used up within a year. Current divided by current liabilities. Current liabilities are amounts of money that you owe to others that need to be paid within a year. Okay. So divide the amount of current assets, so either cash or things that are convertible to cash are going to be converted to cash within a year, divided by current liabilities. So in for example, 2.5:1 means 2.5 to 1. There's 2.5 times as many current assets as there are current liabilities. So in other words, you got 0.5 times more resources to pay your debts. Okay. So again, by themselves, ratios are not really useful. So what does this mean, 2.5 to 1? Again, you got to compare these to something, either to your competitors or to industry averages or to your past ratios to indicate whether or not this is good or bad. Okay. One thing for sure, if this current ratio is below 1, that means we don't have enough cash or things that can be converted to cash in order to pay our liabilities as they become due, and that's not good. Okay. So again, this gives an indication of the ability of a company to pay their debts when they become due. Excuse me. The acid test, or sometimes called quick ratio, measures if a company had to pay all of their current liabilities, so again, the liabilities that are due within 1 year, if they had to pay them all immediately or within a couple of weeks, or at least within the next month, okay, do they have the ability to pay all the current liabilities off fairly quickly? Okay, so that formula is cash, marketable securities. Marketable securities are investments that can be sold fairly quickly. So if you own stock in another company, for example, that's marketable security because you can sell those quickly by just selling them on the stock exchange. Accounts receivable, that's fairly quick because you're going to collect receivables generally within 30 days. That's quick enough for this ratio. Okay. So again, acid test or quick ratio is your cash plus marketable securities plus accounts receivable, and it says net because as you remember from MBA 510, sometimes we set up an allowance to account for those receivables that we're not going to collect. Those are called bad debts. Okay. But anyway, these three items is the numerator, and your current liabilities is your denominator. And then that ratio, the acid test ratio, measures if you had to pay your current liabilities really quickly within a month, do you have enough assets to do that? Okay. Don't worry about this last one. Okay, and as I indicated, what I said before, you take your really liquid means how quickly you can convert things to cash. Okay. The really liquid stuff like cash, since it's already cash. Anyway, these kinds of things, do you have enough to pay your liabilities if you had to pay them fairly quickly? That's what that measures. Okay, another commonly used ratio is the accounts receivable turnover ratio. So this measures the number of times per year that the average receivable is collected. And let me just, yeah. Okay, so in the calculation of that is your credit sales divided by your average net accounts receivable. Average receivable is the accounts receivable at the beginning of the year plus your accounts receivable at the end of the year. Add those two numbers together, divide by 2. That's your average. Okay. And again, that measures how quickly you're collecting your receivables. A more useful variation of this accounts receivable turnover ratio is to convert that into this ratio called number of days sales in accounts receivable. Okay. So basically what that is 365, the number of days in a year, divided by that accounts receivable turnover ratio that we saw in the previous slide. What this measures is how many days does it take to collect your receivables. Okay. So generally, as you remember from MBA 510, receivables are generated when a company sells products or services to a customer and allows them to pay later. Okay, because the company has to sell, or the customer has to sell that they bought from you before they have the money to pay you. So historically, companies have allowed their customers to pay later. That's accounts receivable. Generally, accounts receivables need to be paid within 30 days. So 30 days is generally a average number of days sales and accounts receivable ratio. So that's saying that it takes them 30 days to collect their receivable. If it's higher than 30 days, that means your customers are not paying you on time when they're supposed to. So it's just an indication of potential problems if your customers aren't paying you when they're supposed to pay you. Okay, and that has a lot to do with who you're giving these credit terms to. Yeah. If you offer anybody the ability to pay later on, there might be companies who don't have the financial wherewithal to pay. So that's the reason that there's bad debts. People don't pay their receivables. So this ratio here is just giving an indication of if there is a problem with customers not paying you on time. Okay, inventory turnover ratio shows the number of times in a year that an inventory item is purchased and then sold, purchased and then sold. Okay, so for example, inventory turnover ratio of 12 indicates that 12 times a year you're buying and then selling inventory. So once a month you buy it and then you sell it. Another way to say that is how long does it take you to sell your inventory? The formula for that is your cost of goods sold divided by your average inventory. And again, average inventory is the inventory at the beginning of the year or month or whatever time you're looking at, plus the ending inventory. Take the beginning plus the ending and then divide by 2. That's the average. Okay. So it shows how quickly your inventory is being sold. What's a good ratio? Well, that all depends on the type of company it is. So as an example, women's clothing, let's say. From the time a clothing store buys inventory, how long should it take to sell that inventory? Generally, women's clothing, it's 4 times a year is the inventory turnover ratio, mainly because of seasons. And women's clothing, women buy new clothes every season. So there's 4 seasons in a year. So 4 is probably a normal inventory turnover ratio for women's clothing. On the other hand, let's say Spam Musubi at 7-Eleven. Between the time 7-Eleven gets it, they need to sell it, I'm guessing, within the day. So I'm guessing the inventory turnover ratio for Spam Musubi is 365. So they have to sell it every day. Probably even faster than that, I would guess. On the other hand, let's take a Jaguar dealer. Okay, a Jaguar dealer, from the time the dealer purchases the Jaguar from the manufacturer, it sits on the lot. I'm guessing it might take up to a year to sell that Jaguar. So the inventory turnover ratio for Jaguar might be 1, okay, 1 time a year. So it takes them a whole year to sell the Jaguar. So again, this ratio measures how quickly you sell inventory, but whether it's good or bad depends on what you're comparing it to. You got to compare it to something. The thing you're comparing it to is called a benchmark, okay? Something that is like the goal, sort of, that you want to compare to. So you would compare to your competitors, for example. You would compare to industry averages, or you'd compare to how quickly you sold stuff in the past to see if this year you're selling things quickly enough. Okay, so that's what the inventory turnover ratio measures, how quickly you're selling inventory. And again, just like all other ratios, the ratio depends on what you compare to. Total asset turnover ratio is your net sales divided by your average total assets. And just like all the other averages we've seen in ratios, averages the beginning balance plus the ending balance. Add those two, divide by 2. That's the average, in this case, total assets. Okay, and the total asset turnover ratio measures how well you're using your asset to generate sales. Okay, so are you generating a lot of sales from the assets that you have? That's what this measures. Okay, so obviously the higher this ratio, the better, because that means you're generating more sales from the assets that you have. Okay. Okay, so now long-term solvency ratios measures the relationship of debt to your total assets. So debt, as you remember, is when you borrow money. So debt financing, you're borrowing money. Equity financing is you're selling stock. Which is better, to borrow money or to sell stock? Well, kind of depends. And in your finance class, you've covered this or will cover this. But debt, if you borrow money, you have to pay back interest. For equity financing, okay, when people buy your stock, you pay the stockholders in the form of dividends, okay? But that is not required. Some companies don't pay dividends. So the cost of the equity can be zero if you don't pay any dividends. So debt, there's always interest, and you have to pay the interest. You got no choice. Equity, you can pay dividends or you can choose not. So the cost of equity financing totally depends on how much dividends you're going to pay. Okay, that's the concept of financial leverage. Okay, and again, that's more of a finance class item, so we won't get into detail on that. But the equity ratio shows how much of the assets were provided by shareholders, so your stockholders' equity section of the balance sheet, divided by total assets. So this measures how much of your total assets were provided by stockholders as opposed to how much was because of borrowed money. Okay, so the more equity you use to acquire assets, the better. Okay, and remember, equity also includes not only the money that stockholders put into the company, but all the accumulated earnings, the net income as well. Okay, so internally generated money is the equity ratio. Okay, so you can see some of the benefits of, or some of the characteristics of equity ratios. So a high equity ratio means that the stockholders and or the company itself through earnings provided most of the funds for assets. So that's good for creditors, yeah, because that means that there's money for paying back any loans. Low equity ratio, basically favorable financial leverage. That means they're using the money that they borrow to generate a lot more money. So that may be the case. Okay, yeah, and that's enough for that. Okay, so another item in ratio analysis, profitability tests. So profitability tests basically measure how profitable a company is. Okay, so return on operating assets is operating margin, and operating margin is defined or calculated as your net operating income. So operating income is money that you make from doing your normal day-to-day operations. Okay, not from selling stuff, not from borrowing. It's your normal day-to-day operations divided by net sales. So operating margin basically measures how much profit is there in each dollar of sales that you make. Okay, again, operating margin, what is a good operating margin? What percentage of profit should you be making on selling the stuff that you're selling? That all depends on what it is you're selling. So for example, grocery stores, okay, for every dollar of sales that they make, their operating margin is probably 1 to 2 cents. So they're only making a couple of cents on every dollar of sales they have. So how the heck do they make money? And we'll talk about that in turnover. Turnover is how quickly they sell stuff, okay? Or how much stuff do they sell? That's turnover. But operating margin is how much profit do they make on each item they sell. Grocery stores, 1 to 2%. On the other hand, jewelry stores, for every dollar of sales, how much profit is there in there? It's probably really high. Their operating margin, I bet, is close to 90% perhaps. Okay, so they're making 90% on every dollar, to making 90 cents on every dollar that they sold. So they're making a lot of profit on each item. That's high margin. Okay. Turnover, as I indicated, is how quickly the company sells things, the volume basically of what they sold. So grocery stores only make a couple of cents on each item, but they sell a lot of items. They have high turnover. And that turnover is measured by your net sales divided by, whoa, I, oh, wait, what? Sorry, I'm getting something really weird here. Okay, I think we're okay. Okay, so, oh, sorry. So again, turnover is how the volume, how quickly and how much the company sells. So an example of a high turnover company would be, let's say, Costco. Okay, Costco doesn't make a whole lot on each thing they sell, but they sell a lot of things really quickly. They have really high turnover, low operating margin, but really high turnover. So the rate of return on operating assets, which is a really commonly used ratio in the world of finance, net operating income divided by operating assets. Or an equivalent mathematical equation is your operating margin times your turnover. Okay, they both, this and this third bullet point, are the same calculation, just reworked a little bit. Okay, but that measures how much money are you making overall on the utilizing the assets that you have. Again, think of operating margin is what is the percentage they make on everything they sell. Turnover is how quickly and what high volume do they have of selling. Okay, so again, the Jaguar dealer, high operating margin. Well, let's take jewelry store, high operating margin, because they make a lot on each thing they sell. Sorry, but turnover is low. They don't sell them quickly, and there's not a high volume of jewelry sold. Okay, so the way they make their money is high operating margin, not high turnover. The ideal company has both high operating margin and high turnover. So I'm going to have you think about a company that makes a whole lot of money on each thing they sell, and they sell a whole heck of a lot of them very quickly. That's the ideal, because then you have a whole lot of profits. So spend about 20 seconds thinking of a company that has both of these. Okay, they make a lot of money on each thing they sell, and they sell a lot of stuff really fast. Okay, so here's what I indicated: high turnover, low margin, grocery stores, Costco, that kind of thing. Low turnover, high margin, jewelry stores, the Jaguar dealer. Okay, so my question about company that has both high margin and high turnover, so that's really ideal. The example I like to think about or use is Apple computer. Okay, not so much on the computers, but let's say on their phones or iPhones or iPads. They make a lot of money on each one of those, and they sell a whole bunch of them. So that's ideal. They have high margin and high turnover. Okay, okay, another ratio, net income to average common stockholders' equity, shows, and the formula is net income divided by average common stockholders' equity. And you remember stockholders common, sorry, stock has two different classifications: common stock and preferred stock. This particular ratio just uses common stockholders' equity. So how much money did common stockholders put into the company? So this ratio measures how well a company is using what the stockholders put into the company to generate net income. Okay, so again, rate of return on average common stockholders' equity, or sometimes called, in fact, more often called, return on equity, ROE. Again, net income divided by your average common stockholders' equity. And again, when you see average, that's beginning of the year plus end of the year. Add them together, divide by 2. Okay, and then again, this is a ratio that measures how profitable a company is. Cash flow margin, your net cash provided by operating activities. And again, operating activities are your day-to-day operations. Okay? Take the cash that's generated from your day-to-day operations, divide by net sales. That gives you cash flow margin. So how much cash is being generated from your sales. Another really commonly used ratio is earnings per share of common stock. Okay, and that ratio is the earnings available to common shareholders. What that means is your net income minus your preferred stockholders' dividends. Okay, that's the numerator. And then the denominator is the average number of shares of common stock that was outstanding. The reason it's called weighted average is, I don't know if you have a homework assignment where you need to do this, but if the number of shares of common stock changes during the year, you have to take a weighted approach. So for example, if you had 100,000 shares for half a year, that's equivalent to 50. If the number of shares of common stock changes, then you have to do this weighted calculation kind of thing. Okay. And again, earnings per share common stock measures what is the amount of income that was generated by the company that belongs to each share of common stock. Times interest earned ratio, which is your income before interest and taxes divided by your interest expense, basically measures the ability to pay interest when interest comes due. So the higher this ratio, the better. That means you have more income to pay off any interest that you owe. And again, this is an indication of the ability to pay interest as it comes due. This times preferred dividend ratio, don't worry about this much. Let's see. Okay, this earnings yield, this is more of a, again, finance class topic, but just to touch on it, the earnings yield, that means your earnings per share divided by the current market price of the common stock. As you remember from your finance class, or as you will learn in your finance class, the market price of stock goes up or down continuously. So whatever the current price is at the end of the period, you divide that into earnings per share, and gives you a figure called earnings yield. So that basically is a measure of how profitable a common stock would be. And again, in the world, in the world of finance, that's a very commonly used ratio there. Price earnings ratio as well. It's often used in finance to determine if stock is overpriced or underpriced. So it's the current market price of a share of common stock divided by earnings per share. And remember, earnings per share we calculated in a previous slide. But again, this ratio kind of determines whether a stock is expensive or it's cheap. Payout ratio, again, used quite commonly by financial investors, is your dividends per share divided by earnings per share. And that basically measures how much of a company's earnings does the company pay back to shareholders in the form of dividends. Yeah. So, a high payout ratio means the company is paying a bigger percentage of its earnings back to the shareholders in the form of dividends. Okay. So for people who are investing looking for dividends, then they look at a high payout ratio. But just because a company doesn't pay dividends doesn't mean they're not a good company. For years, Apple Computer didn't pay any dividends. They paid zero. Okay. But what happens to the income a company makes that it doesn't pay out in dividends? It reinvests it in the company to help it grow. So it's not necessarily a bad thing if a company doesn't pay dividends. Okay, so for a growing company, that's a good thing. They're going to put the money, their earnings, back into the company to help facilitate growth. Okay, companies that aren't growing but that are stable, they may pay out more in dividends, and their ratio may be higher. Yeah, because they're not growing, they don't have to put the money back into the company, the earnings, so they pay it out to the shareholders. Okay, so again, this payout ratio um, needs to be compared to something to determine if it's good or bad. Dividend yield is annual dividends per share divided by current market price per share. And again, that measures how much are you getting back as a return on the money that you invested in your stock. Okay, but again, high dividend yields doesn't mean it's a good company. Low dividend yields doesn't mean it's a bad company. Okay, remember, dividends are profits that are paid out to shareholders and that are not kept in the company in the form of retained earnings. So again, this is used to kind of determine, hey, if I buy this stock, how much will I get back in the form of dividends? Okay, but it's just like an indication of this financial strength of a company. No, this is not that critical. I think that's about all I'll talk about. I think the main thing is just to remember that all this analysis stuff is just a um, indication of financial strength. Just by themselves, they're not definitive. Yeah, so if a ratio is bad, that doesn't mean the company is bad as a whole. This just gives some indications, some not really quick and dirty, but kind of just ballpark how a company is doing and how strong they are. Okay. Um, okay, so this is all the stuff that we went over in the chapter. Um, at the here are some um, of the commonly used ratios and the calculations thereof. This is all in the chapter. So this is just a summary of all those. Again, you have all these in the chapter, so you can refer to that to refresh your memory about the calculation of the different types of ratios. Okay. Yeah, and that's it for chapter 12. Um, let's see. So what Easter egg shall I put in here? Okay, so my favorite physical activity is playing golf. Okay. Okay, so that's it for chapter 12. Do the quiz online, and I'll see you later. Aloha. What happened?